Before we start, I need you to read that important disclaimer. There will be 2 pages, 1 and 2. So the main idea, past results are not indicative of future profits. And let's start talking about the current position of the market. And today we will be mostly talking about ESmini. So this is the 5-wave up fractal. We always start from that fractal. Every trending move in a market, in any market, either it's a stock or stock index or cryptocurrency or bonds, they would be following that fractal, and that was the cornerstone of the Elliott Wave Theory. R.N. Elliot came up with a brilliant idea in 1930s, over 90 years ago, and that theory still works. The version of the Elliott Wave Theory I use currently is called the Harmonic Elliott Wave Theory. So it's a modified, in my opinion, a better version of the classic Elliott Wave Theory. Both versions are based on a great assumption that every trending market would be repeating some specific pattern. And this is the main pattern of the Elliott Wave Theory. This is 5-wave up pattern. And the classic Elliott Wave Theory believes that there will be 5 waves, 1, 2, 3, 4, and 5, and every trending wave, every motive wave, wave 1, 3, and 5 itself would be subdivided into 5 microwaves. But if you ever try to use the classic Elliott Wave Theory in your trading, you would know that in many cases, the fifth wave, the final fifth wave, would not complete with perfect 5 microwaves. And in 1990s, a veteran FX trader called Ian Copsey suggested a slight modification to that theory. And what he did is that he proposed to not to expect perfect 5-wave microstructure inside waves 1, 3, and 5. The classic Elliott Wave Theory agreed that in corrective waves, wave 2 and wave 4, there should be ABC subdivision. And what Ian Copsey said, what if we use the very same rule for impulsive waves, for waves 1, 3, and 5, and that actually makes a lot of sense. So if every wave is subdivided into ABC, ABC of 1, ABC of 2, ABC of 3, ABC of 4, and ABC of 5, that would make much bigger sense because every wave should follow the very same rule. And what it turns out that rule, that idea works much better in real life. And the whole idea behind the Elliott Wave Theory is that we try to identify that repeating standard fractal in the current tape of the market, in the current actual chart on any time frame. And I will show you how we can do that later in that webinar. So I think that at that moment, so in February 2020, ESmini and Nasdaq topped in that wave 3, which started in March 2009. So we are dealing with a macro fractal, a macro rally that started in March 2009. And let me show you how that 5-wave up fractal has been unfolding so far. So let's start with wave 1. This is March 2009. And we got A up, B down, and C up. This is our wave 1 up. Then we got pretty shallow wave 2, A, B, C, or wave 2. It retraced 38.2%. So when we get a corrective wave 2, we got that corrective wave 2 down in October 2011. We measure the preceding rally in wave 1 in this case, and it retraced 38.2% of that preceding rally in wave 1. Once we get 1 up, 2 down, that's a standard bullish setup. And it's a standard bullish setup because what should happen next is a strong rally in wave 3. If we come back to the fractal, if we are here, this is wave 1 up, wave 2 down, we should expect wave 3, which is much stronger. Normally, it should stretch at least to 176.4% of the distance covered by wave 1 projected from the bottom of wave 2. This is the very minimum extension of wave 1. And we should remember that it should have two legs up, A of 3 and C of 3, and C of 3 should be longer than V of 3. Those are strict rules which are stipulated by the Harmonic Elliott Wave Theory, the modified version of the classic Elliott Wave Theory. And we can see now details of the rally that started of the law made in October 2011, and look at that rally. The rally in subwave A of 3 should be at least as strong as the whole wave 1, but in many cases, as in this case, it was much stronger. You can see that that rally, the first leg up, took 4 years, almost 4 years from October 2011 to May 2015. Again, we come back to the fractal. If we get the first leg up in subwave A of 3, we should expect a corrective pullback, ABC pullback in subwave B of 3. And this is what we got, ABC. It was a pretty shallow one. You can see that it retraced a small portion of that rally in subwave A of 3. Once we get that ABC down, we should expect the strongest part of the rally. Look, we got that ABC, and this is a model, and I'm just showing you the model and the actual chart of ESmini just to show you how perfectly ESmini was aligned, has been aligned with the standard fractal. And of that law made by subwave B down or wave 3 up, we should get the strongest part of the rally. In subwave C of 3, it should have at least, it should have an impulsive structure, meaning we should be able to count 5 microwaves inside that move, ABC of 1, 2, ABC of 3, 4, ABC of 5. Now let's look at the actual chart of ESmini. Again, we are starting from the law made by subwave B down, and we are getting 5 waves up, 1, 2, 3, 4, and 5. And we came to the top made in February 2020. And once we make the top of wave 3 up, of a major wave 3 up, you see I put it in parentheses, meaning that this is a wave, a macro wave of a higher degree. We should expect a corrective pullback in wave 4. And normally that wave 4 would be subdivided, meaning it would be composed of 3 waves, A down, B up, and C down. Let's look at what we got of the top in February 2020. We got a very strong drop. And yes, if we go to a micro time frame, so we are now looking at a weekly time frame, we can see some ABC subdivision. This is how monthly chart looks like. This is a great chart because you can see the whole move that started of March 2009 low up to the current top made in February 2020. And you can see wave 1 up, 2 down, and 2 legs of the strongest part of the rally in wave 3, A, B, and C of 3. First conclusion would be that most likely the top made in February 2020 was not the major top. Why we can do that? Because if we come back to our fractal, you can see that wave 3 starts from the bottom of wave 2. It should be subdivided into ABC. It should have 2 legs up. You see those blue segments, that one and that one. Subwave C of 3 in no case can be smaller than the first leg up in subwave A of 3. Coming back to our actual chart, we can see if you measure the distance covered by subwave A of 3 and you compare it to the distance covered by subwave C of 3, you will see that subwave C of 3 was slightly bigger than subwave A of 3. You may say, and many people said, what if wave 3, major wave 3, topped here and that was major wave 4 down? And we can eliminate that scenario right away if we compare the length of that move up to the length of that move up. And this is why, by the way, the modified version, the harmonic Elliott wave theory, is better than the classic version, because under the classic version, an Elliott wave analyst could say that was wave 1 up, 2 down, wave 3, wave 4, and the final wave 5. And that would be another problem, because in this case, if you count this one as wave 5, that wave 5 would be longer than wave 3. And even though the classic Elliott wave theory allows to do that, in my opinion, it actually contradicts the main idea behind the Elliott wave theory, where wave 3 is supposed to be the strongest part of the rally. Now let's come back to where we are now and what is the main question for analysts and traders. Look, we got that very strong drop. I told you that normally when we deal with wave 4, that wave 4 should have a clean ABC subdivision. Not only that, there is so-called alternation rule. We have two major corrective waves inside the 5-wave up fractal, wave 2 down and wave 4 down. And the alternation guidance says that if wave 2 and wave 4 tend to alternate in terms of depth and complexity. Let me remind you how wave 2 looked like. This is wave 2. It was shallow and it was very, very simple. In this case, the classic Elliott wave theory says that under alternation rule, under alternation guidance, wave 4 tends to be more complex and deeper. Let's come back again to the actual chart. If we measure wave 3, started off October, of the low of October 2011, and to the top made in February 2020, we can apply retracement tools. You can find the retracement tool in any trading platform, even in TradingView, which is a free platform, and you can perfectly use it for wave analysis. So you can see that that spike drop that bottom in mid-March 2020 retraced 50%. Based on that retracement, that could have been the whole wave 4 down. So the most important question now for us is whether we can count that sharp drop down from the top made in February 2020 into the low made in mid-March 2020 as the whole wave 4 down. Let's come back to the fractal. If the low made in mid-March 2020 was the major low made by wave 4, then the move up we have been watching since the mid-March 2020 was the first leg up in the final wave 5 up, which is supposed to make a new higher high over the top made in February 2020. But even in this case, the first leg up tends to stop at the top made by the preceding rally in wave 3, meaning that if that was a major bottom, then that rally should find a very strong resistance at the top made in February 2020. But I do not think the mid-March low was the major bottom of wave 4. And I do not think so because, as I mentioned, that wave 2 was pretty simple. That wave 4 can hardly be as simple as that drop. I would expect to have a full ABC structure. And that means that the rally we have been getting from the mid-March 2020 is a corrective wave B up, that one. Now, you can see that in this particular case, wave 4 is portrayed as a flat structure, meaning that we get ABC down of A, ABC up of B, and the final drop down, which normally comes as an impulsive drop. That means it should have 5 microwaves inside the drop, either making a new lower low under the low made by wave A, we are talking about the low made in mid-March 2020, or making a lower low. What is great about the Elliott Wave Theory that it not only gives you one fractal to work with, but that fractal itself can be subdivided into smaller fractals. Then, when time comes to answer the question whether market bottoms or topped, completed or not completed some structure, you can always zoom in to see more details. So here you see the very same A, B, C down structure of wave 4 down. But in this particular case, I show you a detailed fractal, the path which is normally followed by price when it is making a corrective wave 4 down. We got that ABC down, and the drop that bottom in March 2020 was structured exactly like that ABC down. The first A was 3 waves, another 3 waves up, and in this case, the final drop was supposed to have 5 waves, and this is exactly what we got in ESmini and NQ. Of the mid-March low, we were supposed to get 3 waves up, A up, B down, and C up. And look, C up was supposed to have an impulsive structure. Let's look at the actual chart. So this is the daily chart of ESmini, and we would only be focusing now on the move down of February 2020, drop to mid-March, and a bounce which came back to 29.40 tonight. First, we can see that we have a clean ABC down subdivision. That ABC down subdivision is a tricky one, because this is why many analysts would tell you that ABC down was actually the whole wave 4 down. Again, let me show you what I mean. Look, the whole 4 down, the whole wave 4 down should have an ABC structure. But the trick here is that the first drop is itself normally structured as ABC. This is why many analysts prematurely call for the major bottom of the whole wave 4, and we call for continuation of the rally. And this is why wave B is so tricky, because it can keep pushing higher and higher up to the top. Even in extreme cases, it can push up to the top made by wave 3. In our case, that means in extreme case, that market would come back to the top made in February 2020. Or in sometimes, in even more extreme cases, under so-called expanded flat structure, that wave B could even make a slightly higher high. But let's come back to the actual chart. When I talk about different alternative scenarios, different possibilities, you should understand that trading business is a business about dealing with uncertainty. You cannot escape uncertainty completely. There always will be several potential counts, several potential scenarios. Our job is to identify situations when we have several alternative scenarios, but with similar outcome. That means, for example, if it was wave 4 down in mid-March, then that move up could be either wave B up, and then we would get a strong drop in subwave CO4, or if mid-March made that low, then that rally anyway would top, and even in that case, we would get a drop in subwave B up before we get the very final strongest part of the move in wave 5 up. Let's come back to the actual chart. In the actual chart, we see that I count the drop into mid-March 2020 as the first leg down, and I count the move up that followed as a corrective subwave B up. When we deal with the corrective wave, we use retracement ratio. We measure the drop made by subwave A, and we add retracement ratios. You can see that we have passed 58.6% retracement ratios. Many traders would be following a classic 61.8% retracement ratios. I don't like it because too many people know about that. And in my personal opinion, from what I see in the markets, market nowadays does not respect that ratio that much. We can see that ES could make another higher high, meaning it could test that level to 29.85, because where we have 66.7% retracement ratios, meaning 2/3, so that bounce would retrace 2/3 of the preceding drop. In addition to that, under the Elliott Wave Theory, we can measure waves and compare their size to each other, because normally waves would relate to each other by certain specific ratios. You can see that at that level, subwave C, if it topped here, would be equal to subwave A. And this is why we got that retracement, that pullback. But the problem here again is that too many traders know about 100% extension. Everybody knows it. And this is why, on the one hand, we got the pullback from that level, but on the other hand, that was just a temporary pullback, because 100% extension nowadays hardly can produce any meaningful resistance. But we deal with confluence of targets. Confluence of targets means that we produce different targets based on different methods. For example, we measured the drop, we added retracement ratios, and then inside that pullback, we measured segments of the move up, and we relate them to each other, and we got two extensions. We measured subwave A up, we projected the distance from the bottom of corrective wave B, and we got two levels, 100% and 123.6. You see that the first confluence produced a nice pullback, and now ES is approaching that level. But let's now go deeper to a lower time frame and see what we can get on a lower time frame. So this is 4-hour chart, the very same picture. We got the first bounce in subwave A up, ABC down in subwave B down, and of that point, we are supposed to get an impulsive push higher in subwave C. And together that up, B down, and C up comprises corrective wave B up. That was A down, parentheses, and that is supposed to be B up. And at that point, when ES topped at 29.65, it looked like a complete count for the corrective wave B up. And it still looks like that. And off the top, we got a very promising drop, which I counted, which I labeled as small A down. And I expected a pullback and B up. And the move up that we got last week looks very much like that B up, minor B up. And as long as that push higher today, tonight, and tomorrow is holding under the top made at 29.65, I would still consider the top of that corrective wave B is done, is made, and that A down, B up, I would be considering as a bearish setup for the drop in subwave C down. And we can see that we can identify two most probable targets for that move down. But the first target would be to retest the low made by wave 4 down every time the 5-wave up fractal, even on a micro level, gets completed. 1, 2, 3, 4, and 5. You first focus on the low made by the preceding corrective, and that 4 down was located around 27.30, 27.20. That would be the first target. But in addition to that, in this specific case, You can see I drew that green line. This is, I would call it a support zone, because you will see in the market that the strongest support becomes the previous resistance level, the level which managed to stop a major pivot, a major move. And we can see that that level around 27, 26.30, 26.40 managed to stop several swings, swing up, swing up, swing up. Then it managed to stop retracement down. And with no doubt, that level has a lot of significance. But first, we need to see whether bears would be able to defend that previous top at 29.65. Now let's go even deeper into that. Let's look at 30-minute chart of ESmini, and we can see more details. Whether the top of a major wave be up, the whole pullback after the drop of February 2020 into mid-March 2020, we can see that subwave C got a perfect completion that was microwave 3, microwave 4 down, and the final 8.5. And we got a very promising drop in subwave A down. Out of that low, and you can see it found support in minor support zone, demand zone. Here you can see that we got so many showing that there was a lot of unfilled orders, and this is exactly where the drop down stopped. And you can see the very next level where the next drop could find support, 27.20, 27.30. This is exactly what I was talking about like minutes ago. Wave fall down, we are zooming in and we see it here. You see how many times bears tried to go through that level, they failed. And no doubt that level would work as support again when bears start attacking again. What would be the first sign that the whole structure has completed and we are going to get that strong drop down in subwave C down? In my opinion, the very first sign that bears are down would be push down under the dashed red line, and that red line is located around 8.85. If bears defend 29.65 and then price, I'm using here a pitchfork, and even if we drop under that channel, that would be the very good sign under 2900 that bulls drop the ball. And if we drop under 28.85, expecting first retest of that zone, 27.80, 27.50, but I do not think it will hold in the next time. Would get a drop at least to 27.20, 27.30. Now the question is, what if bulls manage to make a new higher high? So under the current fractal, I may that major wave B up has already topped. But that might be wrong assumption. Maybe bulls would be able to make a new higher high. I still maintain my bearish bias because that first drop down was too quick, and I always tell you that the rally that tapped in February 2020 in wave 3 took more than 8 years, and it's very difficult to believe that the drop that took only 2 months was all wave 4, especially if we take into consideration that the preceding corrective wave 2 was also very shallow and it did not take a lot of time. So based on alternation guidance we discussed earlier in this webinar, I still think that we can expect a complex wave 4, meaning that it could be subwave A down and we are dealing with a corrective subwave B up. Now let's talk about NQ. NQ has a very similar picture. In the very same way, I believe that the top made in February 2020 was the top of a major wave 3 up. And of that major top, we got a very deep and strong drop, which itself is subdivided as A, B, and C. You see it here. And we have the very same uncertainty. Many analysts believe that ABC down was all of wave 4, and what we are dealing now with is start of wave 5 up. But again, I think more likely is that we are still in wave 4, and that was A of 4, that is B of 4, and at some point we will get C of 4, which could get under the low made in mid-March 2020. Again, once we deal with the retracement, with the corrective wave, we first measure the distance covered by the preceding impulsive drop. In this case, it's not an impulsive, but it's the first leg down in A. When we deal with wave B, we always focus on retracement levels. And in this case, two major retracement levels for our interest are 76.4 and 85.4. Those are retracement ratios which are common for the harmonic Elliott wave theory. In the classic Elliott wave theory, we may use different ratios. I personally used to practice the classic Elliott wave theory for 4 years, and I use different ratios. In my opinion, the ratios proposed by the harmonic Elliott wave theory are more efficient. So, in my opinion, the next, if we slice through 76.4, the next major resistance level would be 92, 98, so let's say 9300, and we are very, very close to that level. Now, we can also switch to a lower time frame in NQ, and we can see the very same story. That rally does not have an impulsive structure. That is A up, that is B down, which itself is subdivided into ABC, and then we got some ugly 5-wave up structure. We got very small 1, 2, ABC of 3, ABC of 4, and the final A up, B down, and C up. Again, if you join that webinar, not from the beginning, I can tell you that I practice a modified version of the Elliott wave theory, which is called the harmonic Elliott wave theory. And the harmonic Elliott wave theory stipulates that every single wave inside 5-wave up fractal has ABC subdivision. The classic Elliott wave theory believes that only wave 2 and only wave 4 are subdivided as ABC, and waves 1, 3, and 5 are subdivided into another 5-wave fractal. In my opinion, unfortunately, the real market does not work in such a perfect way. So if we look at the actual chart for our chart of NQ mini, we can see A up, B down, and 5 waves. I can count 5 waves of that final wave C. And the whole week, the last week, I was telling my subscribers that we should expect that final up to make a new high, and NQ finally made that new high either on Thursday or Friday, and tonight it's making another high, and this is exactly how subwave C of wave 5 should behave. And again, we can apply not only retracement ratios, but we can also, and we should apply extension ratios, because subwave A and subwave C inside that final wave 5 should relate to each other. In the very minimum case, subwave C should be at least 76.4%, and we see that the price has already sliced through that level. You see it got some minor resistance, came back up, retested that level, and started to move higher again. The next meaningful level would be 100% extension, which is located at 93.50. Yes, it can push a bit higher. It could get to 116.4, 123.6. Unfortunately, you cannot predict in advance what specific target it would top. If you want to short that market, you either build a short by tranches, you never go short at once, or many people prefer a safe approach. They would be waiting for first signs of reversal. For example, you see I drew channel here. You can wait until NQ drops under 9,000, and that would be probably a good sign that the whole structure, the whole move up that started in mid-March 2020 stopped if NQ drops under 9,000. But technically speaking, the most important level at this point for NQ is 8340, because as I mentioned to you, every time you deal with a completed 5-wave up fractal, you always watch the low made by the previous corrective wave for down, or 1 degree lower. That wave for down, we call it a corrective wave or 1 degree lower because it's an integral part of that move up. But once we get that ABC up completed, we should get a much bigger drop, which would be comparable in size to the first drop that we saw of the top made in February 2020. So we could get, at the very minimum, we should get the drop down, which would be equal to 76.4% of that drop down. That drop down could be equal in size to that drop down, meaning they would be equal in size, meaning that the drop down would hit 100% extension of the drop down in wave A projected from the top of wave B up. Again, so that was my webinar explaining you how we can use the standard 5-wave up fractal, how we try to align that major model fractal with the actual chart of ESmini or NQ or any stock you want to trade or analyze. And based on the fractal, based on its current alignment with the actual chart, then you can make a prediction. Because if the fractal says the corrective wave should be A down, B up, and C down, and you only got A down and B up, the conclusion is you have to expect wave C down. And either we are here or in NQ or here in ES, I expect continuation of the move down. And I will be waiting to add to my shorts. I started my shorts on Friday, and I will be not in a hurry to add to shorts. I will be buying SPY puts and QQQ puts. I also started SPXX and SQQQ, triple ETFs, inverted ETFs, but I only bought the first tranche. I'm prepared that the market would stretch higher. And what you should normally know about that very last move up, the microwave 5 of subwave C of wave B normally comes as a strong rally. No surprise to see what we are seeing tonight, strong push up. And this is how market works. It wants bears to give up. It wants bears to doubt their conviction about bearish resolution of that A down and B up. And only when bears, many bears, would cover shorts and would start talking about continuation of the move higher, this is when market changes its direction. It happens like that all the time. I started my trading career in 1997. I saw that so many times. I do not have good explanation why it happens like that. Why market treats traders in such a bad way? Why market likes traders, to doubt their conviction? I watch total put call ratio, and the total put call ratio now is under 1. It was actually 0.85, 0.83. You can see those ratios on CBOE website, free data. And when it drops that low, that means that more traders got bullish at this point. So the number of calls written exceeds the number of puts written. And that's another evidence, another sign that that rally is getting too stretched. Too many traders now believe in continuation of the move higher. You see so many calls talking about 3,000, 3,100, 3,150 on S&P, and this is exactly what normally happens at the top. You may remember something like that happened actually in mid-March 2020, when so many traders started to talk about a major breakdown. We were talking about S&P coming to 1,700, 1,600, 1,500, but we remember that it was too stretched by that time. It was too scary. So the level of fear was at extreme. Now we are seeing something opposite. We see that the level of greed is getting to an extreme. More and more people is getting convinced that we made a major bottom in March 2020. I don't think so, and I would keep watching that fractal. So thank you for your time. Again, you may have noticed that I use the Harmonic Elliott Wave Theory, and I recorded 2 video courses. The first video course is for beginners. It's called the Predict the Market with the Harmonic Elliott Wave Analysis. I host a course on the largest educational platform called Udemy. The great thing about Udemy is that you pay only once. You pay $89.99 for a lifetime. You get over 100 video lessons, and you can install a Udemy app on your smartphone or tablet. You can download all those videos to that app, and you do not even need internet to watch those videos. You also can get a couple of quizzes. And the second course is called How to Trade Like a Pro. It actually uses the first course as foundation, and it goes deeper into the same field. It explains better in more details the very same fractals and the way how you can use those fractals in your trading. It explains you how you can convert a fractal into a trading setup, how you can set a target for the move, and yet how you can set a stop for your trade. And there are several hours of videos, like 6 hours of video lessons, and in the very same way you pay only once. Now I run accounts. Instead of $149.99, you pay only $119.99. You can go to my website, www.trader.com, education, read more about those courses. You can read reviews of my students, and you may know that I also run a live trading room, and you can actually participate in discussion during the whole trading day. And another plan is standard plan, where you can get updates posted on my website only for subscribers, and you would get email alerts delivered once a new update is published. Thank you very much for your time. I don't want to waste your time anymore tonight. Please subscribe to my YouTube channel. If you have not joined that webinar from the start, I will post recording tomorrow and to watch that video on my YouTube channel. Thank you so much, and have a great night.